Hey everybody, welcome to this week's Nasdaq Dorsey Wright podcast. Joseph and I are recording this Thursday, January 12th, going to come out Friday, January 13th. We're recording today as markets are kind of responding to some CPI data, but as we were saying, it's pretty much been as expected. Yeah.
Yeah, I mean, really, it was right in line with expectations. Really not too much of a move in market except for pre-market. But other than that, no big changes. We're still in that big range that we talked about last week. So really nothing on the domestic equity side to talk too much about that we didn't cover last week.
Yeah, plenty. I think like what he's alluding to, we'll talk about some more international focused stuff today. On the CPI thing, one thing I did want to note, and I was joking with you about this before, used car prices were down 2.5% month over month, which that's a big jump.
Yeah.
And then sixth straight monthly decline or something like that. So you're getting some price softening there for sure.
Yeah.
Carvana, shout out to Carvana, is down 75% over the past 6 months.
Yeah, that was like a $300 stock at one point, right?
I know. Yeah, it is. It is $6.42 right now.
Yeah.
Got a buy signal yesterday, but yeah, that's brutal.
Yeah.
But we're going to talk about too much of that stuff today. If you want more kind of domestic equity setup, like Joseph said, it hadn't really changed, and that's our discussion from last week.
Yeah.
But this week for international, where do you want to start?
Yeah, I mean, I think the biggest thing that's different from kind of the recent equity rally that we've had from the fall months is that we've really seen international equities participate, which hadn't been the case at all really in 2022.
Right.
So, there's a lot of good data coming out. I mean, I think we talked about this a little bit last week. Europe's situation is kind of better than expected because the weather's been a bit warmer. So their economy isn't, as bad as it could have been. You have China reopening, which is another big deal. We talked a little bit about that last week with regards to oil prices, but we'll get into some of the other impacts there too as well. And kind of a good example of that is on the asset class group scores page, that money market percentile rank, which is just, where does money market rank relative to all 130 plus groups we got? That dropped below 50% last week. And is now at 37%. So a pretty huge drop. And a lot of that has come because of just improvement in the international space. So, a lot of good signs coming out of there from Europe, emerging markets, and, China, Asia area as well.
Yeah, I like how you distinguish how this rally's been a bit different from your March, your June, your August, and even kind of around November when you started to get the international uptick. That's been a distinguishing factor. Somebody were to say what's different for this rally, this would definitely be one. On the positive note, probably, I know Steve has mentioned before, if you're going to get a meaningful market rally, you got to see some global participation.
Yeah.
So something else too, I think on the indicator front, you mentioned the group scores. We stuck this thing on Twitter. It's the RS and X's for all stocks, so domestic and international. What percentage of stocks are in a column of X's on their relative strength chart against their benchmark? So that's just a bunch of jargon to say what percentage of stocks are demonstrating some near-term outperformance versus their benchmark. That hit 50% earlier this week, which is the highest we've seen since 2021. It topped out at 48% on the chart. And if you're watching YouTube, we'll put this on the screen, but it topped out at 48%. And right around March, June, August of this year, and then you hit that 50% mark. So that's another good sign, again, buoyed by the international participation that we can point to.
Yeah, and we talked about how domestic equities have kind of been range bound for a while.
Right.
Other than we're kind of in a big range where there's a lot of stuff going on in there, but pretty much we've been in a big range. International equities really had to find a good bottom, and then they started to rally. I mean, you look at a stock just to look at, for example, is Alibaba, which was at the end of October was at I think about around $59, and now it's trading at around 114. So it's almost doubled since the bottom in October. So that's a big difference on the international space compared to domestic equities. I think part of that is, I remember, I think one of the podcasts I was on a little bit ago was we were talking about the dollar kind of rolling over a little bit. It was right at the first stages. I think it was maybe the first or second sell signal we were talking about. Still above, around 110. And now we see the DXY on 4 consecutive sell signals move to a negative trend, and it's right around 103, 103. So, as that dollar's weakened, we've seen those flows that help the flows go into international equities quite a bit,
Right.
which is, I would say, a good sign overall. Now, you look at the dollar, or the DXY, it's about 50% oversold. So it's not heavily oversold yet. But you're kind of getting a little bit there where you may not get the magnitude of move that you had, from 2 months ago, for example. There's some support there around 101.50, which I would keep in mind, because below that, there really isn't any support until 95.50, which is kind of where we opened up at around 2022.
Yeah.
So that, that could happen. I think it'll probably chop around a lot more before that does happen.
Mm-hmm.
But that's something to be aware of kind of moving forward.
Yeah, the dollar was almost like, so following 22, where it was just a bunch of anomalies, a bunch of haven't seen this before, this typically doesn't happen type of talk.
Mm-hmm.
And then the US dollar, like first sell signal, that was a really good signal actually for international equities, also commodities. The two of those kind of being tied together in a lot of ways. Falling dollar typically is a good time for international stocks and commodities, being that commodities are going to be lower priced given that they're priced in dollars, and then international companies, consumers can buy more with a weaker US dollar. In a nutshell, that's kind of some of the economics behind it. But talking about international equities, I think we can stick with this trend. We've alluded to China a bit, reopening, Alibaba, of course, being a big player and a big name in that space. If you look at a fund like EEM, that's got a huge weight towards China. And yes, positive. A lot of stuff's going for international equities now. For the near term, you mentioned the US dollars getting a bit oversold. I think EEM and emerging markets are also getting a bit overbought at the same time. So EEM sitting at like 76% on its weekly distribution, kind of right at its August highs at 41. And then you mentioned another one, was it FXI?
Yeah, FXI, the China large cap, that's at 101% overbought right now. So
there you go.
Really constructive picture though off those lows and October timeframe. 3 consecutive buy signals for FXI, return to a positive trend. But just a little overextended. If you look at that chart, really looking at pullback to maybe around 29. That's kind of where it broke out or had prior resistance. That'd be kind of normalized territory. So, you could see some of that pull back a little bit, which isn't necessarily a bad thing. That's usually kind of a good action point if you do want to get involved. Because like we said, domestic equity has been very range bound, but international equities have kind of been trending a little bit better recently. So on those pullbacks, there could be quite a few opportunities if you can get a good one with some high RS behind it.
Yeah, and just as a tangent here, we've talked about this probably too much at this point, but if international equities start working, that'd be great for asset allocators, because you don't have to get forced into your domestic mega large cap benchmarks, biggest companies in the world. You actually have some options to get away and get some alpha. So even though we're a bit maybe overbought now for international equities, seeing the moves, and I think a pullback in some of the China space is going to help and provide some action points on FXI. Also on the China point, this may be a bit of a segue into more of the commodities discussion, but China is obviously a big consumer. And I put this piece in the report yesterday about copper. We've seen a lot of movement, commodities, precious metals, base metals being the two, I think, main positives lately, or at least some of the standouts. But start with copper. So if you're looking at a fund like CPER, which is holding futures or backed by futures as the underlying, and then EEM, so sticking with that kind of mega emerging markets theme, China being the carryover, a big weight there. They have a pretty high correlation right now. So copper and EEM are like above 0.6, which over the past, we'll call it 30 years, is some of the highest that you've seen. And we talked about this a bit yesterday, being that emerging markets are big exporters of copper. So Chile, Peru, Australia, Indonesia, and then China is one of the biggest importers of copper. So you're actually maybe getting some kind of economic tailwinds coinciding, kind of helping that correlation, but also just on a technical basis, you saw that price action a bit earlier where copper got back into a positive trend, string of buy signals together, looking like it may get back into its old range.
Yeah, and that's something that's also heavily overbought right now too. If you're looking
Yeah.
at copper futures, you got 72% overbought right now. Great trend though. Four consecutive buy signals back in a positive trend. Um, so I think it was at $4 just a couple of days ago.
Mhm.
Looks like we got up to 416 yesterday. Again, not another place I would be too surprised if we saw a little bit of a pullback. But those are kind of healthy pullbacks out of overbought territory.
Yeah, yeah, and we talked about this maybe like 6 months ago, a year ago, and maybe we can talk about it now again, like just briefly. What do you think about copper starts going, precious metals start going, which is maybe a good thing. You don't really. That's probably what you want to see,
Yeah.
given that you don't want to see an economy go into recession. If some of the base metals, precious metals start running, that's probably maybe a good thing on the surface, but also that could fuel inflation. So it's a bit of a vicious cycle.
Yeah, that's a really good point. And I think that's something you're going to have to probably worry about going into the second half of this year. You may not feel the effects yet. We were kind of talking about this morning how the inflation data is lagging for the most part. But again,
It's telling you how prices change.
Yeah, we alluded to this last week with China and their oil demand coming back. That's the same thing for copper, same thing for a lot of things out there. So where the U.S., we had a rising dollar type of environment, we had the Fed raising rates, which they're kind of near the end of now. Essentially, what we were able to do is kind of export inflation elsewhere. That could kind of reverse to what you're saying as international demand picks up and the Fed's goal of softening the U.S. economy, soft landing, whatever you want to call it. If that's their goals, they're going to be slowing the economy. That's sort of usually kind of deflationary. But you have this international space that's especially China, that's going to be demanding more goods, which may act as kind of a tailwind for inflation. So then you get to the point where, well, what's the Fed going to do if we do get that kind of second wave at the end of this year, which is yet to be seen. But I do think it's something that people need to keep an open mind to moving forward, just to have in the back of their mind.
Yeah. Yeah. And as it stands now, like where we're seeing the indicators in terms of international equities, commodities, even both of those still look pretty strong to us right now, and maybe trending better than U.S. markets at least.
Yeah, I mean, I think the thing with international equities is they really got hit hard, and now they're kind of bouncing back. Where U.S. equities have just kind of been trading in this range, and we do actually kind of see when they, you get that. It's not a V-shaped bottom necessarily, but you do get like a very good bottom like that, and then you start to see a rally. A lot of times there's some good room to run on that international front. Whereas domestic equities, again, we have the Fed's continuing to raise rates. I think upside somewhat capped if you're just looking from a tactical standpoint with resistance overhead on the S&P. Again, you have recession kind of worries. So a lot different picture on both sides. You seem to have like China's willing to reopen their economy, start to get their economy going again, where the US is at a point where they're trying to slow their economy. So it's very two different things going on there, which could be very beneficial to international equities over domestic equities. And that's kind of what we're seeing. I mean, look at the dollar rankings. International equities is second above domestic equities right now. We haven't necessarily seen that on the asset class group scores page yet, but if you're looking at the non-US view, nearly all of those groups have positive score directions. So something to really watch out for through the first quarter, first 2 quarters of this year.
Yeah. Any standouts on the group scores page to you, like specific areas?
Yeah, I mean, I think Europe is the main one. Part of that, I think, is because the winter hasn't been as bad as people were expecting. And then you got, China's been a big improver. That's a group that has tended to, in the past, to have these big jumps in score. But right now, an average score of 2.67 with a score direction of 2.15. So that was like,
China.
This is for China, yeah. So that was very near the bottom of the rankings not too long ago, and is kind of skyrocketed to the middle of the rankings. But really, with that direction, you're seeing how strong of an improvement we've seen from that area.
Yeah, I think something too, talking about going back to your point about really Europe, commodities, copper, China, a lot of this kind of integration here. Natural gas earlier this week hit its lowest levels. What is that, since the end of 21? Was that right? December of 21, as I see it here?
Yeah, it was around 350.
Yeah.
It like pretty much tested that low, and we're seeing it up. I think it got up to it was up over 7 or 8% earlier today.
Mm-hmm.
So that's kind of like a long-term area to watch out for, is that 350 level on natural gas. And below that, you're kind of like, uh-oh, if you're long natural gas or whatever. But that could be a good area where buyers come into play long term. And the weather's been really warm recently, which has kind of been, natural gas is a lot based on the weather. Weather tends to kind of mean revert over time. So as we've had really warm weather the past couple of weeks in the US and in Europe, we could see it kind of revert back to what you usually see. But again, given that it's been warmer, Europe's kind of been able to avoid that crisis situation where they're running extremely low on natural gas storage and things like that. So that may be a little bit out of the question. You may not see, $10 natural gas again on the futures, but you may see, maybe around 4 or 5 after it kind of settles down off these lows if it holds.
Yeah, talk about within commodities too. You're seeing a pretty big dispersion now. So you got precious metals, industrial metals trending pretty well. We talked about copper. Didn't really talk specifically about gold and silver, but those are also still trending pretty well. And energy commodities, not as much, like natural gas being one, crude oil being another, that are still trying to find their downtrend.
Yeah, crude oil's fighting right now. I mean, we've kind of seen that trade around the mid 70s for a while now. You touched on that chart that 2-point chart last week. I've still been able to break that negative trend line on its kind of longer term 2-point chart. But we do kind of see slowing downward momentum there, which is a good thing for energy equities, I would say, which is one of the higher relative strength areas in the market right now, or has been for a while. So you kind of hope that starts to move upwards just a little bit, not necessarily we're getting to 120 again on crude, but just to see it pop back maybe above 80 in the $90 barrel range. And we'll see what OPEC decides to do too. They've been they haven't had any meetings in a while, in a few weeks. So whatever their decision is going to be, if they're going to cut production or just keep it the same, those things will start coming into play too, because it did seem like they really wanted to defend that $85, $90 barrel range. So we'll see if they actually decide to do that at their future meetings.
Yeah. Any other tabs you got open that we want to talk about?
Yeah, I mean, just maybe a last thing, we talked about the precious metal space. If you're looking at GDX, that's a fund that's improved quite a bit. Got a fund score above 4 right now, but it's right up against its negative trend line. And it's getting close to heavily overbought territory, not necessarily heavily overbought, right at 58%. So that could be another place to consider on a pullback if you're interested in those gold related equities. Again, I think really the main indicator, or a good indicator to watch, not necessarily like the bullish percents or anything like that, is just the US dollar in general. That's been a really good sign for if international equities are going to do well, if we see precious metals do well, what are rates doing? They've all been pretty correlated with the dollar movements, either positively or negatively correlated. So I think that's a really important chart to keep an eye on here.
Yeah, no, I agree. So I guess big points would be international equities, very strong, standing out. Actual probably on a pullback at this point, or some normalization. Commodities also perking up again, specifically industrial and precious metals, probably also on a pullback, to be honest. And then overarching all that, keep an eye on the US dollar, is getting a bit oversold, possible to catch some support around here, may revert higher. But that wouldn't necessarily be a change in trend.
Yeah, no, I wouldn't expect it to, I think it'd be tough for it to go back, above, go back to where it was later in 2022. But I wouldn't be surprised, there was a pretty good level around like 107.50 or so, which was support back in September of last year, kind of acted as, once you broke through it, acted as some resistance to the upside on a bounce. So I wouldn't be surprised if we start carving out a range between, maybe that 101.50 level on the low end and that 107.50 level on the kind of the top end on the dollar. Just as the Fed approaches kind of the end of their rate hikes, that CPI data, it sounds like they're pricing in 25 basis points for the next meeting, which they may do for another
it's
2 or 3 meetings
right now, right? Based off the
I think this morning it was priced in at, like above 90% was 25 basis points for the February meeting. So as you get more clarity there, I think the dollar is going to start to stabilize a little bit more. We may not see as much volatility on that end, but that may be a welcome thing after 2022.
Yeah,
so
seriously. Yeah, seriously, 23 is off to a decent start. Much better than 22. So
yeah.
All right. Well, we'll keep doing that. Anything else you think we're good to?
I think that's it. Yeah.
Cool. Well, thanks everybody. We appreciate your time. Per usual, if you have questions, don't hesitate to reach out.